With prevailing interest rates being at almost historic lows and having decreased pretty substantially over just a couple of month period of time, I have a couple of thoughts, a couple of concepts that enter my head. Number one is what I call general account pricing arbitrage. Doesn't flow off the tip of your tongue, but what do I mean by general account pricing arbitrage? What I'm referring to is the carriers, the insurance carriers' general account portfolios, and how they do not necessarily need to reprice products instantaneously. Why is that? Because prevailing interest rates don't immediately impact their giant general account portfolios. Therefore, when you think of a decreasing interest rate environment, there are ways that you can arbitrage, so to speak. I use that loosely, admittedly. Arbitrage by buying insurance products after interest rates have decreased. And I'm going to explain more into detail what I just meant by that. But the second thing that enters my head is this. Let's go back not 2 months, but 2 years ago, for example. Treasury bonds that were issued 2 years ago. What has the price of those treasury bonds done since they have been issued now that interest rates have decreased relative to 2 years ago? And through the lens of talking about that, I want to talk about how, okay, so that annuity that still today guarantees, say, 5% for a 65-year-old, a 5% payout factor forever to a 65-year-old. It guaranteed that back then and still guarantees that, this GLWB rider on an indexed annuity. Shouldn't that annuity, at least from a perception standpoint, at least from a implicit value standpoint, shouldn't that be more valuable than what it was back then? So let's talk about that. So let's say a couple years ago, a 10-year treasury bond. Let's use a very simple small number example. Let's say that the United States government came out and said, hey, we want $100,000 from you, the investor. $100,000. You give us $100,000 and we, the United States Treasury, will pay you a coupon rate, a guaranteed stream of income, that is, a coupon rate of 3%, meaning that the United States government will pay them for 10 years, $3,000. If it's not them, then it's whoever holds the bond over that 10-year period of time, because that investor can buy and sell, can sell and buy a million different times that 10-year treasury bond in the secondary market, which is a big driver of our conversation here. So the Treasury, the United States Treasury, does exactly that. And whoever holds that bond, they will pay that person for the next 10 years, $3,000 per year. Now fast forward ahead to today, 2 years later. Now let's say that the 10-year Treasury comes out and says, hey, we need more money from investors. We need another $100,000. Except this time with this bond issuance, we cannot pay out 3% or $3,000 per year. No, we can only pay out $1,500 or a coupon rate of 1.5%. Why do we need to do that? Well, because prevailing interest rates have decreased. Well, okay, forget this bond that we're talking about today. What about that bond that was issued 2 years ago that is still trading in the secondary marketplace, that is still guaranteeing for the next 8 years that 3% coupon payment? Has the prices, supply and demand, have they increased or have they decreased? Of course the prices have increased, that inverse relationship, right? Why have prices increased? Well, obviously, investors would prefer a 3% income level over a 1.5% income level any day. So looking at how the secondary market treats the value of income generating assets where that income is fixed, looking at it through that lens, shouldn't that same annuity that 2 months ago, for example, just 2 months ago, interest rates were a lot higher than where they are today. Shouldn't that annuity be much more valuable than it was 2 months ago, at least from an implicit standpoint, from a perception standpoint? What about 2 years ago, assuming that that annuity has not had commensurate payout factor decreases? If that annuity was good 2 years ago, assuming that the carrier has not adjusted the pricing on that annuity, shouldn't it be even better today? My response to that is, heck yes, it should.